February 2026. While your neighbors brag about their S&P 500 returns, institutional investors are quietly moving billions into five emerging markets that most Americans have never even considered. One of these markets just returned 48% last year. Another is about to receive $6 billion in enforced institutional buying. And the third? It's been completely written off by Wall Street, yet it's growing faster than any major economy on Earth. Today, I'm breaking down the five emerging economies that could transform your portfolio in 2026. But more importantly, I'll show you which ones are legitimate opportunities and which ones will trap your capital while others retire early. If you're new here, I'm dedicated to bringing you real data-driven investment analysis, not hype, not clickbait, just facts. And before we get started, let me be crystal clear. This is not financial advice. I'm presenting research and analysis. Always do your own due diligence and consult with a qualified financial advisor before making any investment decisions. Here's why emerging markets matter right now in February 2026. The S&P 500 is trading at historically high valuations, around 21 times forward earnings. Meanwhile, emerging markets are trading at a discount, and the growth differential is staggering. But higher growth doesn't automatically mean higher returns. You need real reforms, favorable demographics, and reasonable valuations all working together. Only a handful of markets check all three boxes right now. Let's start with the numbers that matter. Goldman Sachs forecasts 8% returns for emerging market equities in 2026, which exceeds S&P 500 expectations of 7%. That's your baseline. You're potentially getting better returns for taking on additional risk. But here's what most people miss. It's not just about the returns. It's about diversification when it actually matters. Developed markets are expensive. The United States is projected to grow at 2.5%. Europe, maybe 1.3% if they're lucky. Now compare that to what's happening in emerging markets. India, Goldman Sachs projects 6.9% GDP growth in 2026 and 6.8% in 2027. Vietnam, 8% growth in 2025. Upgraded to emerging market status by FTSE Russell effective September 2026. Indonesia, IMF projects 5.1% growth in 2020s. Nigeria, GDP growth expected to exceed 4% for 2025, with the Nigerian Stock Exchange posting a robust 48.1% gain in 2025. Brazil, entering 2026 with muted outlook of slowing growth, but undergoing the most comprehensive tax reform in decades. The question isn't whether emerging markets will grow. The question is, which ones will actually make you money? Let's start with India, the market everyone says you have to own. And here's the truth. They're not entirely wrong. But there's a massive problem nobody's talking about. The bull case. India's real GDP is expected to grow at 6.9% in 2026 and 6.8% in 2027, both above consensus. This isn't a flash in the pan. India's GDP growth for fiscal year 2026 is estimated at 7.4%, reaffirming India's status as the fastest growing major economy for the fourth consecutive year. The structural story is real. India has 1.4 billion people with a median age of 28 years. That's a demographic dividend on steroids. Domestic consumption drives 70% of GDP, making India the world's third largest consumer market. The Reserve Bank cut rates by 125 basis points, and government capital expenditure remains elevated at 3.4% of GDP, concentrated in infrastructure and green energy. Here's what's really interesting. India's digital economy was valued at $42 billion in 2023 and is projected to hit $1 trillion by 2029. That's 20% of GDP. But wait, there's more good news. In January 2020, India and the EU announced they have agreed on a long-term free trade agreement after 20 years of negotiations, which will significantly lower or cancel tariffs on over 90% of goods. The bear case. Here's where it gets uncomfortable. Indian equities are trading at 21 times forward earnings. Read that again. You're paying developed market multiples for emerging market political risk. Indian exports to the U.S., its biggest trading partner, have been subject to tariffs, though a trade deal reducing tariffs from 25% to 18% was negotiated in early February 2026. But here's the thing that's not eliminated, it's deferred. Trump's team views India's trade surplus as a problem, and the next negotiation could go differently. Services exports grew 11% year over year in 2025, but that same sector is getting automated. AI tools are doing junior analyst work. How sustainable is 11% growth in a sector facing structural displacement from artificial intelligence? And currency risk is real. The rupee depreciated through 2025 as capital flowed out, and if the Fed stays hawkish longer, rupee weakness accelerates. The verdict: India delivers if Modi's reforms continue and valuations hold. But you're paying a premium price for execution risk. India may deliver 7% real growth in 2026 and 2027, with equity returns maybe 10% if multiples hold, or zero if valuations compress and the rupee weakens. This is a core holding, but not at any price. Vietnam is the most interesting tactical setup in emerging markets right now, and it has nothing to do with fundamentals. It's all about forced institutional buying. The catalyst: FTSE Russell announced Vietnam's elevation from frontier to secondary emerging market status, effective September 21, 2026, pending an interim review in March 2026. Here's why this matters. Every passive fund tracking emerging market indices has to buy Vietnamese stocks when the upgrade takes effect, with FTSE Russell estimating inflows of around $6 billion from passive index trackers. The removal of the pre-funding requirement historically, Vietnam required foreign investors to have 100% cash on hand before placing a trade as the game changer, with the new non-pre-funding model allowing investors to settle trades similar to developed markets. The growth story: Vietnam's GDP per capita doubled between 2012 and 2024, achieved using export-led industrialization that relies heavily on foreign investment. Vietnam has overtaken Thailand as the region's export powerhouse, especially in electronic goods. Vietnam is the obvious China plus one alternative. Samsung, LG, Olympus, Pioneer, they all have major production facilities there. The risk everyone's ignoring. Here's the brutal truth. Vietnam exports 87.2% of GDP, one of the highest ratios in the world, with the U.S. importing $136.6 billion of Vietnamese goods in 2024, nearly one-third of Vietnam's total exports. Trump threatened 46% reciprocal tariffs on Vietnamese exports that got paused for 90 days and reduced to 20% under the Fair and Balanced Reciprocal Trade Agreement signed October 2025, but that's paused, not eliminated. U.S. trade officials have alleged Vietnamese facilities serve as transshipment points for Chinese goods, circumventing U.S. tariffs. That's ammunition for trade hawks in Washington. The verdict: Vietnam is a tactical trade on the FTSE Russell upgrade with serious geopolitical risk. The upgrade happens in September 2026. The U.S. presidential dynamics matter more for your 2026 returns than any fundamental factor. If you're playing this, you need a clear exit strategy before tariff risk reemerges. Indonesia is the market nobody's excited about, and that might be exactly why it works. Why Indonesia is different: 270 million people, fourth largest population in the world. Economic growth is expected to remain around 5% in 2026, supported by domestic demand, policy continuity, and macroeconomic stability. Indonesia's finance minister projects GDP growth will reach between 5.4% and 6% in 2026, while the IMF raised its 2026 forecast to 5.1%, up 0.2 percentage points from its October estimate. Here's what matters. Indonesia's economy grew 5.0% in the first 9 months of 2025, with growth projected to remain around this level through 2026 and 2027, supported by strong investment and net exports. Indonesia doesn't need a massive reform story. It doesn't need a trade deal. It doesn't need commodity prices to spike. It just needs to keep doing what it's been doing. The structural advantage. Indonesia is the world's largest nickel producer. Nickel is critical for EV batteries. Instead of just exporting raw materials, Indonesia is forcing downstream processing. If you want Indonesian nickel, you have to build processing facilities in Indonesia. Investment throughout 2025 has shown a notable shift towards machinery, investments over structures, reinforced by robust manufacturing growth combined with weak construction growth, underscoring the shift towards capital-intensive industries. The challenges. Despite macroeconomic stability, labor market challenges persist. The economy is creating jobs for most labor entrants, but mostly in low-value-added sectors with many failing to pay middle-class wages, with real wages declining by 1.1% annually between 2018 and 2024. Reform momentum under President Prabowo hasn't accelerated. Indonesia could stay boring forever. The verdict: Indonesia is your diversifier. This is the allocation that doesn't blow up when trade wars escalate. Low volatility, moderate returns. The boring position that looks smart when your growth engines hit turbulence. Nigeria is not for the faint of heart, but if you're looking for asymmetric upside, this is where it gets really interesting. The 2025 performance nobody saw coming. The Nigerian Stock Exchange posted a robust 48.12% gain in 25, consolidating its bullish run that began in the second half of 2023. That's not a typo. While everyone was worried about macroeconomic instability, Nigerian equities absolutely ripped. What changed? President Bola Tinubu eliminated petroleum subsidies immediately upon taking office and unified the official and parallel exchange rates. That's politically toxic. Previous administrations promised subsidy removal for decades. Nobody actually did it. Tinubu did it on day one. Inflation declined steadily and reached below 15% in 2026, down from over 34% in late 2024. Foreign reserves stood at $45.4 billion as of December 29, 2025, providing a substantial buffer against external shocks. Foreign direct investment rose to $720 million in Q3 2020, up from $90 million in the preceding quarter, reflecting renewed investor confidence. The bull case: Africa's largest economy by population, 220 million people. Nigeria's petrol consumption jumped 34% to 63.7 million liters daily as the economy rebounds after Tinubu reforms, with the Dangote refinery expanding domestic refining capacity significantly. International institutions project Nigeria's GDP growth at between 4.1% and 4.4% in 2026, supported by resilient consumer demand, expansion in services such as ICT and finance, and improved crude oil output. The bear case: Nigeria's reform credibility is being tested in real time. Elections create pressure for populist spending. President Tinubu has vowed stronger discipline in budget execution, with the 2026 budget titled Budget of Consolidation, Renewed Resilience, and Shared Prosperity. But execution risk remains. Currency risk is extreme. Security challenges in the Northeast, infrastructure gaps, regulatory unpredictability, these aren't minor concerns. The verdict: Nigeria is a small allocation, high conviction bet on reform credibility. This either compounds at 30 to 40% annually for 3 years or collapses when fiscal discipline breaks down. Size your position accordingly. Brazil is the market that tests your conviction in commodity strength and the energy transition. The tax reform story. Brazil's tax reform, 2026-2032, introduces a phased replacement of multiple indirect taxes with a dual VA8 system, aiming to simplify taxation and eliminate cascading effects. The new system consolidates various federal, state, and municipal taxes into a unified structure. Brazilian businesses currently spend an average of 1,501 hours per year fulfilling tax obligations, which is 5 times the Latin American average. The transition occurs gradually from 2026 to 2033, with CBS replacing PIS and COFINS at the federal level, and IBS replacing ICMS and ISS at state and municipal levels. The commodity advantage. Brazil is a commodity exporter with pricing power. Iron ore, soybeans, coffee, sugar, beef. Brazil is also a renewable energy powerhouse with hydroelectric capacity and biofuels leadership. The growth problem. Here's the harsh reality. Brazil enters 2026 with a muted outlook characterized by slowing growth, with general government debt expected to rise from 87.3% of GDP in 24 to 95% in 26, a very high debt burden for an emerging market economy. Long-term interest rates remain very high in Brazil, with getting to a primary balance surplus crucial to get interest rates down and support economic growth. Brazil's tax-to-GDP ratio is the highest in Latin America. The government struggles to find new revenue sources. The verdict. Brazil's a thematic play on commodity strength and renewable energy. This is a multi-year position, not a quick trade. You're accepting sub 2% GDP growth for differentiated exposure you can't get elsewhere in emerging markets. Here's how sophisticated investors actually think about these 5 markets, not as binary buy or sell decisions, but as portfolio roles. The growth engines, 40% of your EM allocation. India and Vietnam, 7-8% GDP growth, structural reforms, demographic tailwinds, high conviction, high allocation, high risk if reforms stall or tariffs land. The diversifier, 30% of your EM allocation. Indonesia, 5% stable growth. This doesn't blow up when trade wars escalate. Low volatility, moderate returns. The high beta recovery play, 15% of your EM allocation. Nigeria, small allocation, high upside, accept the risk of potential loss. The commodity hedge, 15% of your EM allocation. Brazil, sub 2% growth, but if commodities stay strong or energy transition accelerates, Brazil provides differentiated exposure. Here's my honest take. If you're allocating to emerging markets in 2020, you need conviction in at least one of these themes. Reform momentum in India and Nigeria actually holds. Vietnam's FTSE upgrade creates a tactical window before tariff risk returns. Commodity strength and the energy transition persist. The diversification benefits are real, but you have to size positions appropriately. A 15% emerging market allocation might outperform the S&P 500 by 1 percentage point or underperform by 10 percentage points if macro conditions shift. Nigeria delivers 48% returns again, or it collapses during election year spending. Vietnam gets $6 billion in passive inflows and rallies 20%, or Trump reimposes tariffs. India sustains 7% growth, and your allocation compounds at 12% annually, or valuations compress. Your portfolio, your risk tolerance, your decision. If you found this valuable, hit that like button and subscribe for more fact-based investment analysis. Drop a comment. Which of these 5 markets are you most interested in for 2026? Thanks for watching, and I'll see you in the next one.